Imagine this. You see headlines, right? Hailing a tech founder as an $800 million success story. Sounds incredible, just the kind of narrative we love.
Yeah, the dream scenario.
Exactly. But then you actually dig into the Securities and Exchange Commission filings, the SEC stuff, the official documents, and the numbers. They tell a very, very different story. For John Zimmer, the co-founder of Lyft, those filings reveal he holds Lyft shares worth just $14.56 million. That's as of August 27, 2025.
Wow.
It's an almost unbelievably massive difference.
Yeah, staggering.
So today, we're not just, talking about a number. We're diving deep into this real tension between that public dream and the verifiable reality of wealth.
Okay.
What does this gap mean for someone like John Zimmer? And maybe more importantly, what can you learn from this about understanding the real story behind these viral wealth myths we see all the time?
That's a really compelling point, because this isn't just a simple financial discrepancy, is it? It's really a story about how public perception and the tech world hype machine can clash so dramatically with verifiable truth.
Right.
So we're going to unpack how those huge inflated numbers even come about, why the actual truth is often kind of buried in those dense filings, and maybe the deeper lessons we could all take away about defining success, beyond just the splashy headlines.
Okay, let's rewind then. Back to March 2019, Lyft was making its big entrance onto the public market. Wall Street was absolutely buzzing.
Oh, yeah, I remember that. Big deal.
Huge deal. The IPO was priced at $72 a share. That gave Lyft a market cap of what? Around $24.3 billion.
Right.
And the media, Forbes, Business Insider, everyone, they estimated Zimmer's personal stake was well over $500 million. On paper.
On paper, key phrase.
Exactly. Some outlets even stretch that wealth figure closer to $800 million. It was just the perfect overnight wealth story for the media, wasn't it? Two young guys, Zimmer and Logan Green, taking on Uber.
Pink mustaches.
Yeah, the pink mustaches, the friendlier brand, and then supposedly cashing out with hundreds and hundreds of millions. It was simple, it was emotional, and boy, was it clickable. Fit right into that Silicon Valley dream narrative.
But that narrative, it really begs a crucial question.
Yeah.
What is paper wealth? How real is it?
Good question.
If we zoom out a bit, this whole IPO Mirage thing is a very real phenomenon. It's that sort of theoretical number you get when you multiply a founder's shares by the highest possible stock price.
Right.
Usually day one, right?
Yeah.
When the hype is maxed out.
Right. Peak excitement.
Peak excitement.
Yeah.
But the calculation makes this huge assumption that they could instantly sell all those shares at that price.
Right.
Which, in reality, almost never happens.
Okay, we're not.
Well, so many factors immediately start chipping away at that big initial number. First, you've got lockup periods.
Right. They can't sell right away.
Exactly. Mandated time, usually 90 to 180 days before insiders are even allowed to sell shares. Then there's market liquidity, basically. Can you sell huge blocks of shares without crashing the price? Often, no. Not to mention taxes, which are significant. And of course, the big one, stock volatility. Just the ups and downs. When a company like Lyft trades down significantly, falling from $72 at IPO to under $20 a share today, that Mirage, it can just evaporate almost entirely.
Okay, and here's where the numbers really hit home. Fast forward to today, August 27, 2025. The latest SEC Form 4 filing, this one was June 6, 2025, shows John Zimmer holding exactly 896,240 Lyft shares.
Okay, specific number.
Very specific. Now, if we take the Nasdaq closing price on that date, $16.25 per share, well, the math is pretty straightforward. His total holdings are valued at $14,563,900.
$14.56 million.
$14.56 million. Compared to maybe $800 million, that's a staggering difference of $785 million. It's the difference between maybe being in the top 500 richest Americans and, being a still very wealthy entrepreneur with a meaningful fortune. But the gulf between perception and reality is just immense.
Yeah, it really is. But, for Zimmer, $14.5 million is still an extraordinary achievement. We have to remember that.
Absolutely.
Especially when you think about his beginnings, right? Started with a college carpool idea, lived super frugally in an apartment office with his co-founder.
Right, the apartment.
Worked without salary for years. He even famously left Wall Street just months before Lehman Brothers collapsed.
Talk about timing.
Right. So his journey really forces us to confront this. When we define success, when we chase it, are we pursuing the illusion, that peak narrative? Or are we looking at the demonstrable truth, the stuff grounded in the math? The critical takeaway here, maybe lesson one, is always distinguish between what's flashy and what's actually factual. the headline versus the filing.
That makes sense. So after that initial IPO excitement wore off, Lyft really plunged into a kind of brutal reality.
Yeah, the honeymoon is over fast.
The stock lost momentum, Uber was dominating, and investors started seriously questioning if ride-sharing could ever be truly profitable.
A lot of skepticism, yeah.
So for Zimmer, it must have become crystal clear that building long-term real wealth required way more than just hype. It needed strategy, discipline, a focused approach.
Definitely. The game changed.
This struggle, it really highlighted the need for a major pivot. And that pivot came in April 2023. David Risher, who is a veteran exec from Amazon and Microsoft.
Right, big name.
He stepped in as CEO. Zimmer, who was president then, began the sort of planned transition, stepping back from the day-to-day grind.
Which probably looked like cashing out to some outsider.
Right, you might think that. But the truth seems more nuanced. He stayed deeply invested, he still held his nearly 900,000 shares, but crucially, he allowed the company to evolve under new leadership.
And what makes this so compelling is the transformation under Risher. Lyft went on this really rigorous campaign of cost discipline. They narrowed their focus right back to the core business rides.
Back to basic.
Exactly. And the results. They've been pretty undeniable. By Q4 2024, Lyft generated $1.6 billion in revenue, and this is the big one for the first time ever, posted a net income of $61.7 million under GAAP.
Wow, actual GAAP profit.
Actual GAAP profit. Generally accepted accounting principles. That means meeting the strict financial reporting rules. It wasn't just adjusted earnings, it was real net income.
And that wasn't just a fluke, right? Because in Q2 2025, they reported $1.588 billion in revenue, up 8% year over year, and net income of $40.3 million.
Still profitable.
Still profitable. And maybe even more significantly, they delivered a record-breaking 234.8 million rides in just 3 months. This wasn't about projections anymore. This showed actual cash flow, actual profit, actual customers using the service more.
And beyond just the profits, Lyft also announced a $200 million share repurchase program in Q2 2025. They'd already bought back about 12.8 million shares.
Okay, why is that important for someone like Zimmer?
Well, for a significant shareholder like him, whose remaining fortune is tied up in those 896,240 shares, this is actually far more valuable than any fleeting headline about past wealth.
Oh, so?
Share repurchases basically reduce the number of shares available for public trading the float. This can increase earnings per share, and often it provides a solid lift to the stock price over time. It signals confidence from the company, too.
Oh, okay.
This is really about building what you might call rails of wealth, like durable infrastructure for value, not just fleeting illusions.
Rails of wealth, I like that. And Lyft also seemed to embed itself more into daily life with these smart partnerships, right? Linking up with United Airlines for airport travel, Chase for ride credits, DoorDash for logistics.
Yeah, weaving themselves into the fabric.
And they rolled out membership tiers like Lyft Silver, which apparently boasts nearly 80% retention rates. That seems huge.
Oh, retention like that is gold. These initiatives, taken together, really transformed Lyft from just a casual convenience into more of a recurring, almost indispensable habit for a lot of people. And this brings up an important, maybe emotional truth for founders. Stepping back, letting go of that day-to-day control. It's incredibly difficult.
I can imagine.
But often, real sustainable wealth comes from creating systems that can thrive and generate value even when you're not in the driver's seat anymore. Success in this context isn't about the fortune you flash on paper at one moment in time.
Okay.
It's about the robust rails you lay down for growth, for profit, and for long-term resilience.
That makes a lot of sense. You know, in Silicon Valley, it's so easy to get distracted chasing every shiny new trend, food deliveries, scooters, AVs, crypto.
Well, this goes on.
It does. Yeah. Uber famously tried a lot of those. But John Zimmer, it seems, from the beginning, really believed in focus. He once said, transportation is not about flair. It's about reliability, trust, and habit.
That's a great quote. And very telling.
Yeah, and that philosophy really seems to have shaped Lyft's rebuild. By 2024, 2025, as that initial ride-hailing hype cooled down, Lyft just leaned hard into discipline. Instead of spreading resources thin everywhere, they doubled down on rides and on partnerships that reinforced that core business. No flashy distractions, no billion-dollar moonshots, just execution.
And the data really backs this up. In Q2 2025, Lyft reported 26.1 million active riders, up 7% year over year, and a 14% increase in completed trips.
Wow.
That's not just growth. That's solid evidence of customer stickiness, customer satisfaction. And that Lyft Silver membership you mentioned, with nearly 80% retention, that's pure gold in today's subscription economy. People are staying.
So the genius maybe was in those smart partnerships, integrating with United for airport trips, Chase for credits, DoorDash for logistics, instead of trying to build all that complex stuff themselves from scratch.
Absolutely. These moves solidified Lyft's role as like a key piece of the daily mobility grid, but without burning billions on side projects or chasing trends that might not pan out. And if you look at the broader landscape, this focus over flair strategy, it really stands in stark contrast to that common tech startup tendency to just seek headlines with wild, often super expensive initiatives.
Right, the moonshots.
Zimmer resisted that temptation, seemingly understanding that every dollar put into a side hustle was a dollar not spent strengthening the core business. And the market eventually rewarded this discipline. They started seeing Lyft more as a maturing, maybe essential utility rather than just a risky speculative bet.
And this focus, it kind of echoes Zimmer's own early career choice, doesn't it? We mentioned he left Lehman Brothers just 3 months before it collapsed,
Incredible timing.
choosing instead to build something tangible with Zimmer, that carpool platform. The emotional lesson seems powerful. While his initial paper fortune might have shrunk dramatically,
Yeah.
the foundation he helped build turned out to be sturdier. And maybe the less Lyft tried to be flashy, the more valuable and sustainable it actually became.
It's a compelling argument.
Yeah.
Focus paid off.
Now, speaking of founders, in Silicon Valley, they often cling to control with like an iron grip. They use these dual-class share structures.
Oh yeah, the super voting shares?
Exactly, designed specifically to ensure their votes outweigh everyone else's, even if they don't own a majority of the equity. Think at Mark Zuckerberg at Meta, Evan Spiegel at Snap, the Google guys.
Standard playbook for many.
It is, but John Zimmer in 2025 chose a remarkably different path.
Okay.
And this is where the story takes another really fascinating turn. On August 14th, 2025, Zimmer officially stepped down from Lyft's board of directors.
I'd step down from the board.
Then, just 1 day later, he converted all of his Class B super voting shares into ordinary Class A shares. He voluntarily gave up that special privilege of 1 share equals 10 votes, just relinquished it.
Wow. Okay, that is significant. That's not just a small administrative change. That's
Okay.
Well, it's a profound philosophical statement, really.
Else?
After over a decade shaping Lyft's destiny, he was basically saying this company can and maybe should outgrow the shadow of its founders. This move really completed that 2-year plan of gradually letting go, which started when Risher became CEO in 2023.
Right.
And if you zoom out to the bigger picture again, control is often treated like the ultimate currency in Silicon Valley. It's prized above almost everything.
For sure.
But Zimmer's case highlights this alternative path. By actually surrendering control, he almost certainly increased Lyft's legitimacy, its appeal, in the eyes of big institutional investors.
Ah, the institutions care about that.
Oh, absolutely.
Yeah.
Those proxy battles that happened in 2025, like the pressure from activist investor Engine Capital, a firm that buys big stakes to push for changes, they made it super clear. Corporate governance matters just as much as revenue these days.
Interesting.
A clean, one share, one vote system. It offers transparency. It reassures investors about accountability. It removes a potential point of conflict.
So imagine pouring 15 years of your life into building a company from literally nothing.
Yeah, tense.
Then making that conscious decision that stepping back, letting go of control is the absolute best way forward for the company. Most founders just can't do it.
It's rare, very rare.
But Zimmer seemed to adopt this different perspective. Maybe his identity was tied more to the system he helped build rather than retaining personal control over every aspect of it. With his remaining, $14.56 million in shares, he accepted that Lyft's future would be shaped by collective governance now.
Which raises this really interesting question for us to think about. In a business world where control is almost worshipped, could giving it up actually increase the long-term value of his remaining stake?
Huh. How would that work?
Well, institutional investors, the big pension funds, the mutual funds, they often reward cleaner governance structures. Better governance can attract larger, more stable, long-term investment. So maybe by letting go, Zimmer paradoxically might have secured greater stability and potentially higher future returns for himself and all the other shareholders.
So the paradox here is really striking, isn't it? That $800 million dream was largely about hype and maybe about control. The $14 million truth, conversely, seems to be about release, about structure, about letting go.
Exactly. Sometimes the ultimate act of wealth creation or preservation is knowing when and how to let go.
It's a powerful thought. Now, every fortune, every big venture eventually faces a crisis, right?
It's almost inevitable.
For Zimmer, maybe the harshest blow came after that IPO when Lyft's share price just collapsed. The company was burning cash like crazy, and serious doubts emerged about whether it could even survive against the behemoth Uber.
Dark days for the company.
For a time, that initial dream must have felt completely shattered, just gone.
Yeah, you have to imagine the pressure. But Zimmer's response, again, it wasn't to cling tighter to something that was clearly faltering. Instead, he chose to play the long game.
How so?
Well, by 2023, he and Logan Green made that difficult, but in hindsight, strategic decision to step aside from the top leadership roles, handing the reins to David Risher.
Which, as you said, many saw as maybe defeat at the time.
Right. The narrative could have been founders pushed out. But in reality, it looks more like a calculated strategic retreat. Zimmer seemed to understand that survival and eventual long-term success sometimes means knowing when to empower others to lead, especially someone with Risher's turnaround experience.
And that strategic shift clearly paid off. The turnaround came. We saw Lyft report its first GAAP profitable quarter in Q4 2024.
Huge milestone.
By Q2 2025, it was thriving record revenue, surge in rides. That crisis seems to have forced a profound rethink. Instead of trying to compete everywhere, Lyft doubled down on its strengths in North America while looking to expand abroad more selectively through smart acquisitions.
Yeah, more targeted growth.
And this is where we see another bold, calculated move. On July 31st, 2025, Lyft acquired FreeNow.
Right, the European platform.
Yeah, a leading European ride-hailing platform. They paid about 175 million euros, roughly 197 to $200 million. This move instantly gave Lyft a significant foothold across Europe, rather than trying to build that entire network from scratch, which would have cost billions.
Much faster, potentially lower risk way to enter a huge market.
Seems like it.
And Lyft also, wisely, prepared for the future by partnering with Baidu for robotaxi trials in Europe, which are set to begin in 2026.
Ah, the autonomous angle.
Exactly. It's a measured, step-by-step approach. It reduces the upfront risk significantly while ensuring they still maintain a strategic stake in what could easily become a trillion-dollar industry by the 2030s.
Right.
And Zimmer, by holding on to those nearly 900,000 shares, he retains that crucial optionality. He's no longer betting on just fleeting hype, but on the steady, compounding power of the long game and a business that's proven itself more resilient.
No, emotionally, that's actually incredibly powerful when you think about it. Most founders, after seeing their paper wealth collapse so dramatically, probably would have cashed out whatever was left and walked away.
Very tempting, I'm sure.
But Zimmer kept his significant stake. And that choice seems to reflect a deep conviction, not in those fleeting headlines from 2019, but in the belief that resilience, smart adaptation, and focusing on core value, that's what eventually wins out.
Yeah, it really speaks volumes. This is what we might call the crisis dividend.
Crisis dividend?
Yeah, the value you earn not by somehow avoiding crises altogether, because you probably can, but by enduring them, learning from them, and adapting because of them. His $14.56 million reality might look small compared to that $800 million dream.
Dramatically smaller.
But it's now positioned within a company that is leaner, demonstrably more profitable, and strategically more globally ambitious than maybe it ever was before. Real wealth maybe isn't just measured by what you have at the absolute peak, but by what you thoughtfully hold on to and manage to grow long after that initial fall from grace.
So, wrapping this up, what does John Zimmer's really remarkable journey truly mean for you, the listener? When we reflect on his story, those numbers themselves almost become symbols, don't they?
Yeah, they really do.
$800 million, the dream, the myth, the viral headline we all instinctively click on, and then $14.56 million. The truth, the math, the unvarnished reality sitting there in an SEC filing.
And his story, importantly, isn't one of riches to rags. Let's be clear, $14 million is still an extraordinary fortune by any normal measure.
Absolutely, no question.
But instead, it feels like a profound redefinition of what wealth itself can mean. It's about what truly endures when that initial spotlight moves on.
Like what?
Like the shares you continue to hold with conviction, the positive culture you might leave behind when you step away from direct control, the robust systems that keep producing value even when your own day-to-day role diminishes. His current fortune feels like a reflection of a quiet resilience, and maybe even a kind of humility, accepting that the verifiable truth might be smaller than the initial dream, but also potentially sturdier, cleaner, and far more sustainable in the long run.
This deep dive really invites each of us to reflect, doesn't it? Are we chasing the dream number, the one that flatters us or looks good in a headline? Or are we committed to building the truth, the reality that genuinely sustains us over time?
Yeah.
Are you, listening now, driven primarily by hype? Or do you ultimately trust the verifiable math?
It's a fundamental question.
It is. And now the final question turns to you. If you were John Zimmer today, holding those 896,240 Lyft shares, would you trust in the company's long game, its strategic pivot, its newfound profitability?
Interesting choice.
Or would you choose to sell, diversify your assets completely, and just definitively walk away from the myth, the ghost of being an $800 million founder?
Tough call. What would you do?
We'd genuinely love to hear your perspective on this one. It's not an easy answer.
No, definitely not.
And if you found real value in digging into this story today, please consider sharing it with someone who might need that powerful reminder that behind every dazzling fortune, every incredible headline, there's always a reality check waiting to be discovered.